Hi, I'm Robert Powell, editor of Retirement Daily, TheStreet's newest retirement subscription product. I'm joined by my co-host, Tracy Byrnes, and we have some great retirement experts with us today on the show. We have Jeff Levine, who is the CEO of Blueprint Wealth Alliance, and Douglas Boneparth, who is the president and CEO of Bone Fide Wealth. And we're here to talk about the Tax Cuts and Jobs Act and the retirement planning opportunities that were presented because of this new tax bill. Confusing as it is, we'll try to get through some of the provisions of it and what you can do with your money to make more money because of it. So let's talk about some of the basic provisions that people need to know. I think high on the list are the SALT deductions.
Sure.
You want to start there? Let's start
absolutely.
there.
It's, I think, especially here in the tri-state area.
So we should define what those are too.
Yeah, so this is your state, local property tax type, and
and you were able to deduct it if you itemized on your tax bill.
If you're an itemized person, so if you had a nice house, or you had high property taxes, or you're here in New York City and pay quite a bit, and local, you're getting hit 3 times, right?
That's right.
State and local and federal, of course. A lot of these are going away. So that's probably the biggest part of this that most people are griping about.
Right. But the standard deduction did go up.
It did go up, which I think is going to impact and help a lot of people. But
you can't. You're right. Factually, the standard deduction went up, but it really didn't go up. What was what was said?
Especially for people in the high property tax areas.
Sure. Well, and
your
also
exemption.
That's right. The exemptions went away. So you take let's just use round numbers. Last year, maybe family had a married couple had 3 kids. Let's just take a family like that. They had $4,000 roughly. It was a little bit more, but $4,000 per person in exemptions. So they had, just take a traditional family: mother, father, 3 kids. That's 5 people times 4,000 is $20,000. Plus they had another $12,700 roughly of the standard deduction.
Yep.
And so that was $32,000 plus of tax-free income. Today, they have a $24,000 standard deduction, which sounds great, but they lose the exemptions. So they actually have less tax-free income than they did in the previous year. Now, some of that might be offset with the child tax credit if they have younger children, or the family credit that's brand new this year if they have some older individuals, but it's not a complete offset.
No, because it didn't go up that much, the child tax credit.
The big difference I think you're going to see for a lot of families is a lot more people will be able to afford it. Or I shouldn't say able to afford it. Well, able to take it, exactly, because it went from $1,000 to $2,000, so doubling, which is nice. And obviously, you use the same family. You have 3 kids. You're going from potentially $3,000 to potentially $6,000 of tax credit, which of course, different than a deduction. A tax credit is a dollar for dollar break on your taxes.
Well, when you say it like that, right? No, but it's a good point. It's a good point. You look at all the moving parts and you try and figure out who's going to generate tailwinds out of this thing. And I think you and I probably have seen more headwinds. Especially given that our businesses are here, we're dealing probably with headwinds every single day. Some could say that, hey, that's a champagne problem, but I think it goes beyond just this area. And I think in your examples, you've proven how, there's a lot of kind of combating the reduction in these benefits, particularly around the SALT deduction.
Right. So from an actionable advice point of view, if you sort of fall, let's say, I don't know, you had $10,000 in personal income tax, you had maybe $12,000 in real estate taxes and whatever. At this point, do I start paying down my mortgage and move to a low personal income tax state?
I mean, that's always a good option, right?
Yeah.
Less taxes is always good. As a CPA, that's like hardwired in there.
But I need to arbitrage it a little bit, don't I?
That's right.
I need, there's some things I should do.
The first thing is understand how this is going to impact you, because to the point of, this is the end of the world, we're in a high tax environment, a lot of that is true. There's a great deal of that's true. And, as someone, again, who lives here in New York State, practices in New York State, have significant New York State income taxes. I have a home, there's significant property taxes. But it actually won't impact me as much as I thought it would initially, and doesn't impact a lot of my clients as much as we thought it would initially, because they weren't getting those deductions anyway. Right. In the past, right, AMT was a much bigger issue. Yeah. And for those that don't know, AMT is basically like a shadow tax system. When you come to your CPA, they really prepare 2 returns. They say, I'm going to do your return, but they're really doing 2 returns. They're doing your regular return and your alternative minimum tax return, comparing the 2 and then saying you owe the higher. That alternative minimum tax already eliminated state and local income tax deductions. So many people who live here didn't see the benefit of those tax breaks anyway, or at least not to the full extent that they may have otherwise thought.
It's still, though, not dollar for dollar. When you have some people, expensive homes in this area, $30,000, $40,000, $50,000 in property taxes, and plus state taxes. We in New Jersey, our fine governor just announced they're going up. So like tack all that on. I don't know how I'm going to come out. I'm afraid to do it, quite frankly, because I don't think it's going to be pretty.
I put a for sale sign on your house.
I'm with you.
Yeah.
And that's but the kids are going to have to
fire sale. Everybody's paying attention. She's got to get out.
But I can't move my kids, so they'll stay.
I think you're going to hear the stories of people as this continues to roll out and as returns are being filed in the years to come. I think you're going to hear a lot more of these stories. I think as Jersey residents, we know what our fate is here.
It ain't good.
I can be cynical and say, well, let's hope this does prop up the markets and the economy, and all right, well, I'm an advisor, and that's particularly good for our business. But why do I need to be cynical, about it to think about how this is going to either be mitigated or, in the rare chance, be beneficial to me? I think that speaks volumes for what this might end up doing for a wide variety of people here. But hey, at least there's a private jet deduction, I think, in there.
Yeah, I'm taking your jet home tonight, by the way. Thank you. I appreciate that. Any other itemized deductions that we've lost that we need to think about? I know there's
so many of them. Obviously the big one is miscellaneous itemized deductions completely gone. So you've got people who are paying union dues, or my wife's a nurse, right? My wife's a nurse, and she she has to buy uniforms.
Right.
That was always a deductible as an unreimbursed business expense if you're an employee. That's gone. Doug and I make a lot of our money via advisory fees. Those are always deductible. If you paid them with non-qualified dollars.
So our clients
that's
are
gone.
That's job search fees. People looking for jobs.
Sure.
Like
I think about
tax return fees.
Tax return fees.
I think about my mom. She's a public school teacher for almost 30 years, and I think about all the teachers going above and beyond to get stuff for their students that's not covered by the school, and they literally are not going to get the, however small or large it was, a tax break on that.
Just
kind of a shame. I mean, my heart bleeds a little bit.
Well, especially when they raise the estate taxes, so like that's cool now.
Yeah, I mean the fact that we're still, we have that $250 above the line deduction for educator expenses. To your point, so many educators spend more than that per year. I mean, you can spend that much on crayons.
For sure.
How I felt about the student loan interest deduction, same kind of stuff going on there. It's like, you're phased out at, people with $250,000 in student loan debt. You're telling me,
that's right.
They're usually working some pretty good jobs, but
you better if you've got a $250,000 in student loan debt.
Exactly. It's just a total misalignment with the incentive and what it is.
It is arguably on its way to AMT, though. Like they're slowly taking away.
Oh yes, absolutely.
Things. Like we're on our way to almost being in a full AMT system.
Well, that's why almost no one this year. AMT is not technically eliminated on the individual side. On the corporate side, it was a full repeal.
Right.
But on the individual side, it's not a permanent repeal, or a full repeal, I should say. But it's basically gone because the exemption is higher now. The amount of income, I think, for married couples with joint returns, it's now $1 million before you start phasing out that. And a lot of the changes that, let's say you had a $50,000 state or local income tax deduction last year, that would have been an adjustment. This year, the biggest it can be is $10,000. Take away the. So most people, it's virtually impossible to be, in AMT this year.
Curious to see those who with personal AMT being who are the winners there, where AMT goes away, but they still lose that on their deductions, and yet net a positive. I'm curious, who are going to see on that.
What we're seeing mostly is that a lot of people will end up paying tax on more income, but at a lower rate. And the real question is, which is going to make, is it you're going to have so much more income taxable that even at the lower rates you're paying more, or is it that the lower rates will trump, for lack of a better word, the additional amount of tax you're paying? And look, altogether, 3/4 of the country is going to see lower taxes. The question is, how will,
So a lot of my readers are retirees, and obviously they're concerned about the medical expense deduction, right? Which could be a problem, right? Because the retirees oftentimes, they may have expenses that are expected and manageable, but then they also have those unexpected healthcare shocks that really, and now this goes away for
There is a lot of concern around that when we talk to our older clients.
What to do?
Well, the good news is they lowered it, right, for this year. So that's we got
a year.
That's right. We got last year they made it retroactive to the beginning of 2017, and then they added 2018, and then it goes away. It's like one of the weirdest things as the law. It goes, from 7.5%, which last year, for those that aren't aware, it was supposed to go from 7.5% for older individuals of 65 or older up to 10%. And they actually retroed it to the beginning of the year, said we'll keep it at 7.5%. And that's still the case just for this year, though.
Yep.
Then it goes up higher next year. So in essence, what it does is it makes a smaller amount of your medical expenses deductible. You have to get over a higher income threshold before you can get a dollar
because
break.
It's 7.5% or 10% of your adjusted gross income. That's hard to meet.
And on top of that, even if you
barrier.
do that, you still have to get above your standard deduction, which is now higher.
Right.
So a lot of people aren't going to be able to claim those expenses.
It's a weird conversation because you ask, well, what can you do to plan for this? And I mean, what are you going to tell people? Like, oh, I
have fewer medical expenses.
Heard you had a big
surgery.
Heard you had a big surgery coming up.
Is this where the HSA comes in?
I think that, I don't know, I mean, nothing's really changed all that much on the HSA side of things, but if you have the ability to fund that HSA.
That's right, having those tax-free dollars in retirement could be more valuable.
Yeah.
Right, maybe that's where,
Mm-hmm.
like you're saying, you make choices of what to fund first. Maybe we start to fund that first.
So that's key here. I mean, this would go out to all the people who, have neglected it or have chosen not to do that in favor of retirement. Well, now you're going to get this dual-purpose vehicle
and
here.
if you have medical bills, maybe that's a conversation.
Assuming you're in a position with an
Right.
employer, with an HSA, and you can afford to fund it.
We're not countrywide yet, and
Yeah,
we're also
exactly.
not.
And what sample of the population is that?
Right.
So,
And
okay.
People misuse their HSAs
Well,
too.
behaviorally, right. We're still
they
at zero
use it as
balances
slush
at year
funds,
end.
exactly. Like, oh, well, I have these $3,000 I put in. Oh, I have $2,000 of expenses. Let me use my HSA. When conceptually it should be, I'm not touching my HSA unless I absolutely have to. I have no other sources from which to pay this money because, let's face it, as we just talked about, as you get older, your medical bills aren't going down. They're not going away. So let's leave that money in the HSA. Let it compound. Let it be tax-free. There's no bigger proponent of retirement savings, than me. I love retirements where I spend my entire life digging through, retirement concepts. I have a very exciting life.
But you do have 2 kids, so
that's right. That's the other. That's the
Plenty
most
going
important.
on.
I want their retirement to be good too. But the first dollars that someone has generally should go into that HSA because it has triple tax benefits that no other account has. Deductible on the way in, tax deferred growth, and if used for medical expenses, which everybody has, it's tax-free on the way out. It is the holy grail of accounts.
That's a good point.
Actually, someone has actually told me that it's quadruple tax benefit because they're on the way in. It's also not taxed at the.
That's fair. Yep.
Right.
Absolutely. Yep.
Right.
Yep.
For fear of this getting edited out of our discussion, like exercise, stay healthy. I mean, we don't talk about this anymore.
That's fair.
We're very.
No. You're right.
It might be a throwaway, but we're very much caught up in this. Like one thing I actually do tell clients is, hey, look, your body,
your control.
body's like. Literally, it is in your control, and it will have an impact. No joke.
Right.
I'll just throw it out there. Why not?
All right.
It's a good point.
So if this was Jeopardy and there was a category, the last one left, it would be QBI, right?
Okay.
No, you don't want it? Okay.
This is like the history of the world, and we
Yeah,
formula
something
everywhere.
like that. Okay, but there's a lot of debate around this legislation around pass-through income and how should I incorporate? Should I reincorporate? Blah blah blah. And there's a lot of confusion.
The biggest impact that might have to a lot of retirees or close to retirees is, today a lot of people continue working in some way, shape, or form in retirement. And a lot of people do it as a consulting. That's right. They go back and, maybe they work somewhere for a long time and they just say, hey, you know what, I'm going to come in, 3 days a month and you're going to pay me as a consultant because you want my brain. I just don't want to be here all the time.
Give me the 1099.
Exactly. You get the 1099 and now for most of those people, regardless of what field they're in, they're going to see 20% deduction of that income. It's a big number come off the top.
Yeah.
Unless they have income, if they're single in excess of $157,500, or if they're married and file a joint return in excess of $315,000. Those, by the way, being taxable income numbers. So after the standard deduction and it's come off and so forth.
So if someone's making $100,000 consulting,
doesn't matter what you do.
Right.
Yeah, exactly.
So it goes down to 80.
That's right. Goes down to 80,000.
Regardless if I'm an LLC or a C corp or an S corp.
Doesn't matter. Well, there are some little caveats here. For instance, if you're an S corporation, you don't get to take the break on the salary you pay yourself. It's only on the business profit. So there are some
But you should explain why it goes down to 20 grand.
The QBI deduction, a qualified business income deduction, probably the singular most complicated provision of the new tax law, the Tax Cut and Jobs Act, in there. It creates a new section of the tax code, section 199A of the tax code. And 199A, well, everybody knows 199A, right? Come on.
I was reading this on my honeymoon.
So section section 199A, this QBI deduction, basically says you get, in general, a 20% deduction for your business income on the lesser of your qualified business income, which if your Schedule C is your net profits, if your partnership is your net income from the partnership, if you're an S Corp, it's your business profits. You get that 20% deduction on the lesser of that amount or on your taxable income. And again, for individuals today, that could be worth a lot of money.
Yeah.
Now, as your income gets higher, it gets a lot more complicated. We could spend 5 hours talking about it. Then you have to figure out what type of work do you do? Do you, if you're in a white collar profession,
there's all these limitations.
Yeah, there's a ton of limitations. Whether it's type of work, W-2, if you have depreciable property, there's a lot of complications.
Not to mention, I've heard that some tactics around married filing jointly and
being married separate. That's right.
Separately.
Generally speaking, married filing separate is like a hex.
Right.
You only do it unless you really are concerned your spouse is like cheating and
on
the taxes. That is, cheating on taxes, and you don't want them to. You don't want to be responsible for their tax bill if they're lying. There's not a lot of good reasons. People ask all the time, should I file married separate? 99% of the time, if you're trying to pay less tax, the answer is no. This might be one of those scenarios because the law explicitly says it's if you have income of $157,500 or less, you're good, unless you file a joint return with your spouse, then it's more. So basically they're lumping in single filers, head of household, and married filing separate individuals in this category altogether, and it's so rare for a married couple filing separate to have the same benefit as a single filer or a head of household under the tax code.
Don't you wish
you
were
got all
in
that,
the
right?
room when they were all sitting around coming up with these these rules?
I mean,
it was almost like it was written in a hurry.
Right, like that's just crazy.
Like in the margins.
I wanted to know where in the where in that conversation they were literally like categorizing the groups of Americans that would fall into each of these categories.
And probably knowing there's not many.
Well, and are they red and blue, and do they vote?
And
That's right. That's right.
And
is there at least a graph?
Oh, let's be honest. The SALT repeal, which we talked about before, the SALT reduction was really, I won't say the word, but it's really a big penalty. Middle finger to blue states, right? I mean, who tend to be higher taxes. That's,
for sure.
So let's talk about maximizing Roths, right? There's an opportunity because of the tax cut bill that we can now take advantage of them?
Absolutely.
How so?
Yeah, I mean, basically, we have lower rates today than we may ever see. And so the Roth and the traditional IRA are really like the yin to the yang, right? So if you think you're in a lower rate today than you will be when you hit retirement, you're better off paying that tax now or not getting a tax break in the case of a Roth IRA contribution, and then having it be tax-free later. And as we've talked about in the past, you also have an element of insurance there when you put in money into a Roth IRA, and that what if taxes go up in the future? Look, if they don't do anything, we said that about 70%, 75%, 80%, depending on the study you believe, let's say 3/4 of the American public right now will pay less in tax than they did last year.
Right.
Now, whether or not you think that's a good thing, countering out with the, the increased deficit, that's a whole political discussion. But fact is, if we're just talking taxes in a bubble, most people will pay less. Well, flip that back on its head in 2026, if we do nothing, that means 3/4 of people will be paying more tax again, right?
That's when it ends.
Right. Put money into the Roth now, potentially.
And the best thing you can really do here is have some idea of what things are going to. I mean, there are a lot of assumptions you need to make, a lot of questions about where rates are going to be. But, I was always taught the tax triangle. And this was basically a concept that allowed you to put as much flexibility into your tax planning, especially on retirement. So that's, hey, if you have an opportunity to fill up buckets of Roth dollars, pre-tax dollars, and taxable dollars, if you can have all three, you can be more nimble and you can plan a lot more strategically when it comes to actually taking that money out.
Gives you choices.
So exactly. So whether rate, it's the mitigation of we don't know where rates are going to be. Arguably, this is the lowest.
Yeah, no.
We have no idea over ages in terms of how long you're going to live and things like this. So to have this kind of flexibility is really key. But yeah, put that money in that Roth if
because it could be used for. You could, again, pass it on to your heirs.
Yeah,
sure. It doesn't go through probate. I mean, there's a lot of good.
Shouldn't go through probate.
It shouldn't go through probate. There's a lot of good to the Roth.
And no requirement of distributions.
Yep,
you could actually take your money when you want. What a concept,
know.
right?
How about this? The fact that, and a lot of young clients of mine enjoy the fact that the contributions they're making to their Roth, not on conversions with separate rules, but if they actually made a pure Roth contribution, they love the idea that if things got hairy, there's those contributions that they can take out penalty and tax-free. One of the few things out there that you can take your contributions out before earnings and do so. So, you know, whether that's the cash reserve plus, let's not go so crazy because it's not assured, but
But if you only have $5,000, why not put it there if you always have access to it?
Double option.
Right, you keep it in cash. There's nothing wrong with that.
I think that's a great little tip, actually.
So speaking of youngins, right? The impact of leaving retirement accounts to young beneficiaries.
Yeah.
Roth, traditional. Does the tax bill speak to that?
Absolutely.
Yeah.
So again, you know, looking at the current tax situation, Roth IRAs generally going to be tax-free no matter who gets it. Generally, there are some weird, you know, scenarios where that may not be the case, but most of the time,
will have to take the RMD.
That's right. Roth IRA beneficiaries don't get that same no RMD.
But at least they get it tax-free.
That's right. They generally get that money tax-free. Exactly. Yeah. Nothing wrong with that, right?
Every young kid should go home and tell their parents to open a Roth IRA. Like
I hear CPAs, especially given that I work with a lot of young families. You know, they ask me, "Are you going to put money away for your daughter in the Roth?" Doug, you have to do it. You have to do it. You know, and the reason for that is the impact that it has for a child over if you can afford to do this. I mean, and I do see. Ironically, what I see is when younger family, young clients come into practice, I see that they have like a pretty robust Roth IRA, and I'm like, there's no way, but there's no way you did this in the last like 10 years of you working. Their parents were savvy enough and giving enough, and they made those contributions.
It's a great deal that a lot of those kids have, right? They go, they earn, they spend their own money, and then their parents put the money into the Roth IRA.
I love it. Yeah.
It's a pretty good deal. Yeah.
But to your point, note to my kids, I didn't do that.
That's all right. Sorry. The big change we talked about leaving money to young people is that a lot of times, financial advisors like Doug, myself, we would tell clients, one of the best things you can do for young kids is to leave them your IRA because you take out distributions based on how old you are. So, for instance, you leave an IRA to, a 40-year-old. A 40-year-old is taking out something like 2.5%. I think the distribution factor for 40-year-olds is like 43.6. So you divide the prior year-end balance by 43.6. It's like 2.5%, let's say, right? Your account makes 5%. Not only did you take money out, but it's going up each year. So we've a lot of times said, hey, don't even leave it to your kids. Leave it to your grandkids, right? Because they will have even longer to stretch. Now, there's still an element where that makes sense because it's such a long time that they can have that tax deferral over. But under the current law, they changed the Qbi tax rules. The Qbi tax rules used to say that if you have unearned income as a young person, and again, a lot of other ancillary things and conditions and so forth, tax mumbo jumbo, but if you have unearned income, so interest, dividends, capital gains, IRA distributions, right? That would be taxed at your parents' rate. It was meant to stop parents from shifting assets and income to their kids.
Right.
But now, under the law, it's going to be taxed at trust tax rates, which is generally much worse. You or I don't get to the top federal tax bracket now of 37% until, depending on how our filing status is, $500,000 or $600,000 of taxable income. Trust this year, $12,500.
Ouch.
That's it. And you're already at the 37% bracket.
Up there. So it's come down from what, 45?
That's right, from 39.6.
39.6, and now you're getting a big break on. No, you're not. It's like they really don't want you shifting money around like that. They didn't want you before. Now
it's even more, right? So you have to balance that long distribution period with the potential for higher taxes, and maybe that's even incentive more for you to convert during your lifetime, where you can fill up your nice big tax brackets and leave that Roth IRA to a grandchild where it's not an issue.
It's almost like they want to generate more tax today. Does someone need to get paid?
Yeah,
is that all right?
Well, yes, but except for why do they do away with the estate or increase the estate?
Right.
Oh, there's an answer for that.
Yes, of course there is. There is. There's an answer for everything. All right, my favorite topic, QCDs, right?
Yes.
Qualified charitable deductions.
Yeah.
right? So this has been one of those things where it's been on, it's been off, it's been on, it's been off, but now it's back on.
That's right. Finally, a couple years ago, we had the clarification. I think it was part of the PATH Act a few years ago, where they said, hey, we've got QCDs that they are a quote-unquote permanent feature of the law, which of course means it's here until Congress. That's right.
Yeah.
So the qualified charitable distribution provision is a provision of the law that says you can take money out of your IRA and give it right to charity. And you have to be 7.5 or older to do this, but it can satisfy your required minimum distribution up to $100,000 per year.
Right.
Now, the really great part about this...
And you get the charitable contribution.
So that's actually the really great part about this, right? Is that you get to exclude the income entirely from your tax return to begin with. So you don't even need to take the charitable contribution because it never even goes on your return.
That's a good point.
You're avoiding ordinary income.
That's right.
At
And it's so much better. There's a few reasons why this is better than, let's say someone is charitably inclined.
Wait, so it doesn't even go on your Schedule A?
You'll see it on your 1040 as a gross distribution if it's got to be from an IRA.
Right.
So on line 15A, assuming you have no other distributions on your 1040, it's going to say I took $10,000.
Right, like an IRA distribution.
That's right. On line 15B, the one that says how much is taxable, it's going to say 0. And right next to it, there's going to be a little notation on the return that says QCD, which stands for Qualified Charitable Distribution.
And so nothing on the Schedule A?
Nothing on your 1040, right? Schedule A being the itemized deductions. You're right. You wouldn't put
You're not going to see a charitable deduction on there.
So you get a 1099.
That's right. And people hear, oh, I'm not going to get a deduction. That's terrible. No. It's better.
No, it's better.
Because you're never even going to put it on your return. Think of, I'll give you 2 examples where this can be much better, especially more so than ever this year. First being, let's say you've got let's just make somebody a very high income person. Let's say they've got $250,000 of income and they want to take the QCD of a full $100,000, right? Unlikely example, but just keeps our math easy. Yeah. If they take that money out of their IRA and add it to their income, now they've got $350,000 of adjusted gross income. Will they get to take a $100,000 itemized deduction? Yes. But now your AGI, which is like halftime on your tax return, right?
Yeah.
And unlike the Super Bowl, right, of a couple years ago, you remember the Super Bowl a couple years ago?
I do.
Right, a big Pats fan. The couple years ago, the Super Bowl score at halftime, Atlanta was crushing the Patriots. No one remembers what the score was at halftime because who cares? It doesn't matter. Patriots won the game, right? On the other hand, on your tax return, halftime may be the most important score. AGI is key to many of your deductions, your credits, et cetera, and how about now Medicare Part B, Part D premiums, key to your adjusted gross income. So even though you get a charitable deduction that comes off, as you mentioned, on your Schedule A, it does nothing to change the score at halftime, and halftime matters here. So that's one example. The other thing is, what if you're not an itemized filer? This year, especially under the new tax law, with the new higher standard deductions, very few people, much fewer people, are going to be taking that standard deduction, or excuse me, the itemized deductions. They'll become a standard deduction filer. If you are a standard deduction filer, you get no benefit for a charitable contribution.
So then, I got to believe you're encouraging people to do this.
If you're 7.5 or older, and if you give to charity, it is the single best way to do it. If I see someone who comes into my office and they're 7.5 or older and they're taking money out of an IRA and they're giving to charity and not using the QCD, my first question is going to be, why? Do you like paying more taxes? Even a $2,000 distribution, if you're in the 22% bracket, that means you're paying $500 almost in unnecessary taxes because you didn't utilize an approach that was available to you.
I want to point something out here real quick, and you know you've done a fantastic job.
Same here.
You qualify for CE credit, by the way.
I need them.
Perfect.
But you did a fantastic job breaking down the new tax code and the new tax changes, and the passion's there for real. But I want to point this out. You got so excited over something that is going to only pertain to over 70, giving money away to charity.
Well, that's what we're talking about.
Those are my readers.
Yeah.
Go ahead.
It's true. It's true though. But if we're
that's what we're talking about.
But if we're talking about this tax bill and like that's a huge win, and it is. I mean, like, look, that strategy is legit. Like lowering AGI through the fact that you're giving money away from your IRA. That's amazing, but it's disproportionately less people out of the entire, like we put this bill out there for everybody, and it's just bringing kind of, you know, hey, is that a personal opinion? Maybe.
Well, in fairness, the law didn't even change it. It's just it makes that existing strategy more important.
Externalities that occur outside from.
So in the couple minutes that we have left, what would be the key retirement planning tactic, strategy that you would tell people in light of the tax bill?
Well, I think that's a big one right there. So we have that. We have, so this is a review kind of summary of things.
Or one we missed.
If you think, I think the big takeaway here is if you think this is a historically low tax environment for yourself, you have a lot of levers that you can pull to put yourself in a tax advantage situation this year and in the years in which we have some of these provisions taking place. We heard it from a charity point of view. We heard it from a Roth IRA contribution point of view. We didn't hear a lot of it from the deduction side of things, which I think is what a lot of people are like, well, how do I? So we have some things here that we can mitigate. We also heard it from families. That was certainly an area where tailwinds are created here. So hopefully you can leverage those tailwinds to go against some of the headwinds that exist here, because there's going to be winners and there's going to be losers out of this. And our goal is hopefully to create more winners than losers. Anything I missed there on the
No, I think that
summary?
was fantastic. I mean, we always should probably, if we're talking about retirement taxation, we might want to add that those that convert to a Roth IRA in 2018 and forward no longer have the ability to undo those conversions. So essentially you're stuck with that conversion income. So it makes the due diligence beforehand really important, right? So 3 things that everybody needs to do are: 1, have a realistic expectation of what those taxes will be. Have a realistic expectation that paying those taxes now beforehand will be materially better for them than if they don't. And 3, have a good plan for paying those taxes, because Uncle Sam is going to want his money whether or not you have the ability to do that. So that would be the first. And then the only other advice I would give out there is the advice no one wants to hear, which is save more, work longer. All right? I mean, that's...
And don't die sooner.
That's right. Save more, work longer, don't die sooner.
Prayer.
You heard it here first.
And say a prayer they don't change the tax law.
All right. Well, that takes us to the end of our half hour. On behalf of my co-host, Tracy Byrnes, I want to thank you for joining me. I want to thank my guests, Jeff Levine from Blueprint Wealth Alliance and Douglas Boneparth from Bone Fide Investors. And I'm Bob Powell, editor of Retirement Daily. Thanks for watching.